Welcome back, ladies and gentlemen. We are live. Let's discuss. First, huge shout out to all channel members, subscribers, and Lit Exchange founding members. Cheers, my friends. You're literally making history. Long story short, the bond market is in trouble. I'm going to give everybody about 30 seconds to jump in here. If you're watching this after the live stream is over, just jump forward 30 seconds. Richard, Huxtable, Zachary, Drop, thank you very much. Huge shout out to Typo Negative, Eagle Eye Productions, everybody else who has been supportive of the channel and of Lit Exchange, the upcoming stock and crypto brokerage. Cheers, my friends. Hey, Terry, great to see you. Rachel, Yvonne, ladies and gentlemen, we're back with another one. This is definitely going to be some interesting information. You guys may have heard me talk about the reverse repo operations program in the past. But to say that things are heating up would probably be an understatement. That 119 right there, that stands for billions. And while, yes, that is a lot of money, that is basically excess capital for money market mutual funds. The messed up thing is that not even 2 years ago, about a year and a half ago, that number was at 2.55 trillion. 2.55 trillion. That's 2,550 billions. In comparison to what it is today, a measly $119 billion. So in a period of less than a year and a half, excess liquidity has been drawn out of the system extremely quickly. The mutual funds here are running out of excess capital from the 2022 highs that we saw at $2.5 trillion to under $120 billion today in the overnight reverse repurchase operations market. This is likely to be a nightmare for the financial system, just like it was in September of 2019. In case you didn't know, there's a very little known bond market collapse via the repo operations in September of 2019. Many people believe, and I do as well, that the whole purposes for the shutdown with the C virus, we'll call it, and the liquidity that was spent by the federal government, printing 40% of all money in existence in the last few years, was specifically related to bailing out the bond market via the reverse repo operations. The Federal Reserve had to take over the reverse repo from the banks because it was absolutely skyrocketing in yields. And if you know anything about bonds, bond yields increasing is not a good thing. The Federal Reserve and the United States Treasury have been draining this excess liquidity out of the financial system by the forced purchases of Treasury bills by money market funds. The United States Treasury is scheduled to sell $185 billion more in Treasury bills tomorrow. They just sold $199 billion in Treasury bills yesterday. This is absolutely monstrous. I have them pulled up here as well, the direct Treasury auction results for yesterday and the upcoming for tomorrow as well. And we've seen now that foreign countries are decreasing their purchases of United States Treasury bills and bonds. Meanwhile, the Treasury has had to issue trillions of dollars worth in order to maintain financial stability in the United States due to the rising debt payments by this country that coincide with the increased interest rates by the Federal Reserve. And a lot of people have been thinking, well, mortgage rates and all rates in general should have come down because the Fed cut. Well, that's exactly the opposite of what happened. I'm about to show you that. Before I do, I'll tell you that yesterday's reverse repo operations usage was $160 billion. And on December 31st, it was over $300 billion. So in a matter of a few weeks, Of course, December 31st is the last day of the quarter. Well, the last day of December, which was an actual business day, I should say, was over $300 billion. Banks use that to cook their books, balance their books. It should be illegal, but they do it. And today we're looking at a measly $119 billion. That's meaning that a good portion of the money market funds cash is being spent on T-bills. Once this is fully depleted, the United States Treasury will have to fund the issuance of new bonds out of the TGA. The TGA is basically America's bank account. It's the Treasury General Account. Think of it as our checking account. Draining the cash from the TGA, of course, will create a situation in which the Fed is buying the majority of United States bills and bonds, much in the same way that Japan has been doing so for a significant period of time. This leads to, of course, further inflationary dangers, as we will be printing more and more money to buy our very own bills and bonds. This is sort of a Weimar Republic situation, if you will. On January 1st of this year, just 2 weeks ago, the Treasury General Account had over $721 billion in cash on hand. Today, January 15th, the TGA has $631 billion in cash. That's a net deficit of $90 billion in a 2-week period. I wonder how much or how little the influx of taxes will help. I would bet that tariffs against other countries would likely yield much more in tax revenue versus income taxes that are being paid or not paid by Americans. So hopefully Donald Trump here will allow us to pay for consumption instead of income taxes via the tariffs through the External Revenue Service, which he has stated he is going to create very, very quickly. And hopefully that means the abolishment of the Internal Revenue Service as well. But as you can see here, this black/dark blue line here is the current 10-year yield. The 10-year bond note yield has risen over 115 basis points since the Federal Reserve began to cut rates on September 18th. This is the first time this has happened in over 40 years across 11 rate cutting cycles. In the past 10 cycles, the 10-year note yield has declined by an average of 103 basis points after the first rate hike. So basically, instead of going down 103 basis points like it has the last 10 times over the last 4 decades, this time it's up 115 basis points. That's a net difference of over 212 basis points from the average that would have occurred by this time. The market is moving in the exact opposite direction of the Federal Reserve. The meeting coming up here on January 29th is likely to be very interesting, and banks and institutions are basically saying that they guarantee that inflation is going to continue higher. That is why they are not reducing mortgage rates and bond yields along with the federal funds rate. Remember that, ladies and gentlemen. That is not good for the overall situation. At the very same time, the mortgage demand in the United States, according to Reventure Consulting, has fallen to the lowest level we've seen since 1995. The lowest level in mortgage applications since 95. Since the peak we saw less than 4 years ago, or right around the same time as the C virus, mortgage applications are down over 63%. Of course, why would this be? It's probably because housing affordability has never been worse. The annual income needed to buy a median value home in the United States has risen to over $110,000. Just a couple years ago, that number was at $65,000. And from 4 years ago, this has doubled from $56,000 to $110,000 in income required to buy the median U.S., so the average U.S. household right now. That's the income needed to buy a house versus the median income in this country. The median income now is 83.4 thousand a year, which is 26.1 thousand less than is actually required to buy a house at the moment as well. So we have a reverse repo operations market that is being completely drained of liquidity. We have treasury bills and bond issuances that are occurring like it's going out of style. Bond yields are increasing at very fast rates, which is complete opposite to everything that's ever happened in the last 10 cycles. So when people say that this time is going to be a little different, I actually believe them. This is going to be significantly worse than any recession we have ever seen in our lifetimes. What we're seeing now in the stock market and cryptocurrencies is a bubble that is reaching its peak. I'm not calling for a stock market crash tomorrow. I'm not calling for a bond market crash tomorrow. But I do think that people need to be well aware of what's happening in our country. And the fact of the matter is that homes for single family living and even for investing are extremely overvalued. Stocks and cryptocurrencies as well. Automobiles, other sorts of assets and liabilities are extremely overvalued. It does not bode well for the majority of financial markets. There are, of course, a variety of different things that people can invest in, tangible assets, silver, gold, inflation-proof, long-term items that could potentially yield to be pretty profitable. As you can see here, the existing single-family houses sold per year in the millions for 2024 is estimated to be lower than anything we've seen since 1995. So there were fewer homes sold in 2024 than 2023, 2010, 11, 2008 or 9, even the dot-com bubble bursting. And here, the fact that home prices are now officially up over 50% nationwide since the C virus, and the S&P has extended its run to over 100% since that same time. To say that this is a historic run and an overvalued market is likely an understatement. Today we saw CPI inflation data. The CPI inflation data showed that shelter inflation is still really elevated, meaning that homes to buy and to rent are extremely expensive. Rent has been increasing at a rate of 4.3%, and homeowner inflation is up 4.8%. This is obviously going to be a while before affordability improves. People are buying fewer homes, they're applying for fewer mortgages, and some people still need to move for a variety of reasons. Airbnb and other invested owners have to sell off a significant number of homes as fewer people are traveling and as the costs goes up and it becomes harder to rent these same homes out. We are looking at a long period of drawn out issues in the bond market, in the stock market, and in the housing market that will likely require government intervention through the use of quantitative easing. That means printing of money, bailouts, and those, of course, lead to more inflation. It's kind of a vicious cycle. Let's put it that way. This isn't all meant to be gloom and doom. This is meant to educate and inform. Again, there are a variety of different ways in which you can invest that aren't necessarily related to cap rates in real estate or the NVIDIA and the NVIDIA and other AI bubble that's currently going in the stock market. One of those would be private equity. Consider investing in private equity, the Lit Exchange Founders Program is now live. And for the first time in the history of the world, retail investors have the opportunity to actually own a part of an upcoming stock and crypto brokerage that is being created for retail investors by retail investors. This has never been done before. No firm has ever given you the opportunity to own a part of the company before their launch and planned IPO. We are doing just that. Instead of going to companies like Sequoia, which is what Robinhood did, they raised $3 million from Sequoia Capital in order to launch. We are going directly to retail investors such as yourself. You can find our listing and filings on the SEC Edgar website, linked directly from litexchange.com. You can also visit the FINRA regulated funding portal and broker-dealer, Silicon Prairie, who is the funding portal for our Regulation CF exempt raise under the Jobs Act of 2012. Again, this is not a GoFundMe. We are not asking for donations. This is an investment in private equity in which you have the opportunity to be part owner of a company before the launch and IPO, so that when we do IPO as planned in the future, you will then have the opportunity of a significant liquidity event. Ladies and gentlemen, I wish you peace and wealth, but I will have to read some of these comments here. Everlong Gaming says, I never thought I would feel relieved about a market crash, but it will be better for the economy after one at this point. And Victor comes to say, I'm an owner-operator driver and can't afford a house or pay rent. I've been living in my rig for over 3 years. 401 Doge, great member of the community, says, what a trooper, Victor. And we agree there. There's a lot of people in the same situation, my friend. You know, I own a third-party logistics and trucking and distribution company called Hotshot Expediting, and we try to pay our drivers and our vendors as much as physically possible. But to say that transportation is in a great state right now would probably be an understatement. So I would bet there are a lot of people that are dealing with very similar situations around the world, my friend, and especially here in the United States. Our was once great first world country is beginning to become a third world country under the Biden-Harris administration and the course of the last 4 years. So I urge you, ladies and gentlemen, to do everything you can to make sure you're properly hedged, to make sure that you do what you need to do for yourself in order to secure your future. There's a significant number of ways in which that could be done, but it doesn't hurt to have some good old silver, gold, food that can be stored long term, and other investments outside of the stock and crypto and real estate markets right now, which is a big part of why private equity investment, which is not currently listed on the stock market but will be in the future, has significant potential. Ladies and gentlemen, we'll be back tomorrow. We can discuss this further. But as of right now, if you don't know about the reverse repo crash of 2019, I strongly urge you to Google it. You know what? I will do it for you really quickly. As you know, I always try to deliver. And I will give you a quick rundown of it. On September 17th, 2019, interest rates on overnight repo agreements, short-term loans between financial institutions, experienced a sudden and unexpected spike. A measure of interest rate on overnight repos, the SOFR rate, secured overnight financing rate, increased from 2.4% on September 16th to 5.25% on September 17th. Doesn't seem like a big deal, but during the trading day, interest rates reached as high as 10% and higher. That affected the interest rate on unsecured loans between financial institutions and the effective federal funds rate, for those of you that don't know. Of course, this was so serious that banks didn't want to lend to each other anymore, and it became almost impossible for anybody to borrow any money, causing a near collapse of the bond and financial markets. The Federal Reserve was forced to take over the repo market and inject $75 billion in liquidity into the repo markets on September 17th, and they had to do so every single morning for the rest of the week. On September 19th, the Fed's FOMC lowered the interest paid on bank reserves. Ultimately, these were successful, and by September 20th, rates had returned to a stable level. However, now the Federal Reserve has had to permanently and regularly provide liquidity to the repo market. This says until June of 2020, but that is still happening today, 2025. This is a very similar situation to what happened in Japan, in China, the Weimar Republic, and the good old Roman Empire. The causes of the rate spike were not immediately clear. Economists later found out that there was a temporary shortage of cash available in the financial system, which was itself caused by two events taking place: the deadline for payment of quarterly corporate taxes and the issuing of new Treasury securities. The effects of this temporary shortage were exacerbated by declining levels of reserves in the banking system. Ladies and gentlemen, what did I just show you? Liquidity being drained out of the system. From $2.55 trillion in money market mutual funds down to $119 billion in less than a year and a half. What else? Oh yeah, there's the shortage of cash. That's right. Due to the deadline for payment for quarterly corporate taxes, which tax season is rolling around here pretty soon, and the issuance of new Treasury securities. What else did I show you? Yes, that's right. The issuance of new Treasury securities. There was auction for about $200 billion worth on the 14th was the issue date. And there's another auction date on I don't know if I said January 14th, but I should have said January 14th. And there's another auction date for January 16th for another $185 billion more worth of Treasury issuances. And this will continue as the government needs to issue new treasuries, Treasury bills, and bonds. And these bills, I looked them up. They are now 4-week and 8-week, but previously, the original issue date was November 19th, 2024. And the auction date will be on January 16th. So these are both 4-week and 8-week bonds, very, very short term. And there will be additional issuances of 13, 26, and 52-week bonds on January 21st. So we can see that this is going to continue over and over again for a significant period of time. Mark Brumfield, how would AMC be affected by all of this? My friend, stocks and crypto will, of course, be affected by a lack of liquidity and a stock market crash. Blue chip safe havens will likely have to be sold off at some point by a lot of the firms that are over leveraged, and they will need some cash in order to maintain their collateral positions or to close out some of their positions on heavily shorted equities like silver, gold, GameStop, AMC, DJT stock, FFIE, and the list goes on. Look up all of the heavily shorted equities. Realize that silver and gold have been being naked shorted by central banks for decades, and that right behind them are some meme stocks that are some companies that have hundreds of millions and even billions of dollars in cash on hand, a significantly long financial runway, increasing profitability and revenues every single month and quarter, and that their chances of bankruptcy are slim to none at this point. Meanwhile, a lot of positions, like those that crashed Archegos family office due to their short positions and over-leveraging against using swaps against companies like GameStop and their fellow basket of securities partnerships like AMC and COS and SLV ETF, as well as when they went insolvent, it took out companies like Credit Suisse, a major prime broker, Switzerland's second largest bank. Now, UBS was forced by the Swiss government to take over Credit Suisse with a deal that stated that if UBS saw over $4.5 billion in losses due to the swaps and derivatives that are very toxic from Credit Suisse, that the Swiss government would give UBS over $9 billion in bailouts. We just saw, if you watched my recent video, we just saw that regulators and former bankers in Switzerland are now saying that they believe that UBS's toxic derivatives are going to cause a crash of UBS, leading to a taxpayer-funded bailout of UBS Bank due to these same derivatives and toxic swaps and options, of course, which are derivatives, and short positions, etc., that were taken out by Archegos that caused the demise of Credit Suisse, that are causing the demise of UBS, and are likely, and also, hundreds of hedge funds, Melvin Capital, Tiger Capital, the list just goes on and on and on. If I stood here and named them all, but you can Google it for yourself. Which hedge funds went bankrupt due to GameStop and AMC? And you'll see over 100. And the hedge funds are the first tier on the totem pole. The family offices, right there with them. Above them sits their prime brokerage, the banks. Above them sits the broker-dealers, stock and crypto brokerages like Robinhood and Webull and IBKR and Charles Schwab. Above them sits the clearinghouses like the DTCC and the NSCC. It's a major systemic failure that has been enabled by those that sit above them, the regulators like the Securities Exchange Commission and FINRA, that allow themselves to investigate themselves and find that they have committed no wrongdoing. I can go into more detail, honestly, and explain this for hours, but I think that this has been enough of a summation for now. Ladies and gentlemen, I wish you peace and wealth. Make sure you're properly hedged. I see you guys, ladies and gentlemen. I appreciate every single one of you. God bless. Before I go, since I'm here, I see you, Brian Smith. I see you, my friend. Cheers. Thank you for your support, Brian, and thank you, everybody.